Hello, I'm Kenny Gott, CFP consultant and president at Pycheck & Associates in Springfield, Missouri. Here's how we help clients tax manage their investments so they can keep more of what's theirs. If your current advisor isn't already doing all this, you can either direct them to this video or better yet, meet with us yourself to see if we should be your advisor. I talk about all kinds of tax management issues in my book, Bottom Line Financial Planning, Manage Risk and Fund the Good Life Your Whole Life, and we'll give you a free copy when you meet with us. But don't depend on a book for current tax information or a video on the internet because tax laws change all the time. And to be very clear, we're not accountants or attorneys. I'm going to be talking about general tax concepts, and before you make any big decisions, get current information and advice from a tax professional. Now, this presentation is about tax management we do for our clients' investments, and I should say some of this may be a little in the weeds for some of you, so call us if you have questions. And there's a lot more to tax planning beyond what I'm sharing today. For example, you have a big role by taking advantage of tax breaks the IRS offers in your workplace retirement savings plan, like your 401k or 403b, Roth 401k, simple IRA plans, and others, and your workplace health savings account, if that's offered. You can save for college with a tax-advantaged 529 plan. Cash value life insurance policies have some tax advantages, and estate planning is a huge tax topic you should be discussing with your financial advisors, including your accountant and attorney. In my book and in client meetings, we discuss lots of tax topics, but regardless of where you get your information, always keep an eye on your whole tax picture, not just these ideas I'm discussing today. All right, here are the big 8 ways we help clients manage taxes in their investment accounts. Now, you may know mutual funds are large diversified baskets of stocks or bonds. ETFs are similar, but with some tax advantages. For one, a mutual fund has to pay out 95% of its capital gains, its growth, each year. Often that's just automatically reinvested in the fund, but you still have to pay tax on it. With an ETF, there's none of that, so essentially the tax on the growth is deferred until you sell. And with the index ETFs, otherwise known as passive ETFs, there's also much less trading activity in there compared to a traditional active mutual fund. So that can reduce capital gains taxes as well. Now, like a lot of these ideas, this doesn't really affect IRAs, which are already tax deferred. This is about taxable accounts like joint accounts, individual accounts, and trust accounts. And the same is true for number 2 here, municipal bonds. The interest earnings are federal tax-free. You'll still have capital gains tax on the growth in the value of an individual bond or fund, but capital gains tax is generally a lower rate than income tax. And again, a muni bond ETF is more tax efficient than a muni bond mutual fund. Now, if a municipal bond is issued in your state of residence, it may also be state tax-free, depending on your state. Next, you may have heard stocks divided into value, growth, and blend styles. A growth style company tends to plow their profits back into the company instead of paying it out as dividends to investors. Value companies tend to pay more dividends. Now, these stock styles grow similarly over the long run, but dividends are taxable even if you reinvest them. So using growth stocks can reduce taxes, again, not in your IRAs, but in your taxable individual, joint, and trust accounts. Next, which account to draw first? Your IRA, your non-IRA, your Roth IRA? It depends on the circumstances, but all things being equal, you want to keep tax deferral going whenever possible and save traditional IRA withdrawals for last. With a traditional IRA, you pay ordinary income tax on all withdrawals because you put pre-tax money in there. You haven't paid any tax on any of that money yet, so every distribution is taxable. So you want to try to leave that alone as long as possible. With a Roth IRA, you pay no tax on withdrawals if you've held it for at least 5 years. And with a non-qualified account, a non-IRA in other words, you pay capital gains tax on the growth when you pull that out. And again, for most people, capital gains tax is a lower rate than ordinary income tax. But if your income is on the verge of driving you into a higher tax bracket in a year, you may want to withdraw from a Roth IRA or a non-IRA account to avoid that. Work with your investment advisor and your tax professional each year on your withdrawal strategy. Next, if you own a stock fund or a stock that is at a loss and another has gains, you can sell them both to cancel out some or all of the capital gains to reduce your capital gains tax over the long run. As of now, you can pick and choose which lots or groups of stocks get sold first when you're raising cash for a distribution. Our trading platform automatically looks for tax lots with lower capital gains when we're raising cash for our clients. Ask your current advisor if it works that way for you. Now, there are strict rules about harvesting a loss and then turning around and buying back into the same holding. But if you use this technique correctly, you can swap losses for gains, reset the clock on some of those gains, potentially save some taxes. Next, as of the time I'm recording this, you can donate up to $100,000 of an IRA to a qualified charity or church with no tax to you or the receiving organization, as long as it's a direct transfer from your IRA account straight to the charity or church. You never touch it. If you have to take required minimum distributions from your IRA anyway, and you're also giving to a church or charity, take advantage of this. It's less taxes for you, so potentially more net money for the church or charity. Our clients love this. Next, if you own an investment account or any asset with growth in it and then you sell it, you have to pay capital gains tax on the growth. The basis is how much you've put into it, and the difference between that and what you sell it for is your capital gain. And again, you pay tax on that. But if instead you pass it along to an heir, they start with a fresh basis. So then they only owe capital gains tax on the growth that happens after they inherit it. If instead you were to sell an asset during your lifetime, even if you turn around and gift the proceeds, you may owe capital gains tax as well as gift tax. Passing it along at death may be a better option depending on your circumstances. Finally, in our Big 8 investment tax management tips, all annuities are tax deferred, which again is an advantage for non-IRA type accounts. In addition to income-only annuities, there are 3 types of annuities geared for investors, and they all have their advantages and disadvantages depending on the investor, and they're all tax deferred. So be sure to work with a professional who understands all 3 kinds of annuities. And that means someone who's insurance licensed as well as securities licensed. Most advisors don't have both licenses, but we do, which is another advantage we bring to the table. Now, the fee structure, the features, all the way down to how they get their growth is very different among those 3 kinds of annuities. But we've used all 3 kinds. For some clients, none of them make sense. For others, an annuity may be a great fit. If so, and if it's a taxable non-IRA account, the tax deferral can be one advantage. Tax on the growth is deferred until you sell, and at that point the growth is subject to ordinary income tax, not capital gains tax. And it's last in, first out, so if you just take out some of the money, the first thing that comes out is the growth, which again is taxable. And we can look at all this for you when you meet with us. So here's our number. Call for your complimentary consultation, and we'll see if your current advisor is tax managing your investment accounts like they should. You'd be surprised how many account statements we see from big name investment houses where they're missing the boat on one or more of these tax management techniques. And we can also look at your investments more generally, see if maybe we can help you invest more efficiently, both from an expense standpoint and from a tax management standpoint. And we can also do a retirement analysis if appropriate, see how much growth you need to enjoy a long retirement and what kind of investment mix will get you there so you can live the good life. As we always say, it's your future, you earned it. Thanks for watching.